Bears getting a second leg down after the follow through 73. But again, do you really want to sell this low in a trading range? Probably not. Hope everybody's doing well. Big bear bar 72, but bottom third of the most recent bull rally, bar 68. You can see not a lot of energy by the bears. So you can look at it right here. Do you really want to sell 72? Not a lot of traders selling the close, and that tells you that we're probably going to be more sideways here. Follow through, but not the follow through you want if you're going to be selling low in what's likely a trading range. It increases the risk of a pullback. Bears getting a second leg down after the follow through 73. But again, do you really want to sell this low in a trading range? Probably not. And therefore, I don't think a lot of bears are all that interested in selling in this area. You can see bears deciding what to do here. You have some bears who sold the close of 72, and they're disappointed with the follow through on 73. They sold 72, disappointed 73, and they're deciding whether or not they're going to scalp out. Strong enough bar 72, probably at least a little bit lower. But again, I suspect there's probably more buyers below the 59 low rather than sellers. So not an ideal location for the bears. What about buying and putting a stop below the 59 low? That would be buying, that would be exiting right at where there's probably more buyers. It's possible we get a bear breakout to the downside, but realistically, I suspect we're getting a lot of buying pressure, and therefore I suspect there's buyers below 59. So if I'm buying anywhere in here, I'm not going to put a stop one tick below 59. I'd rather use a wide stop. Or if I was long, I'd exit on 72 and then wait for a reversal up. But realistically, unless we break far below 59, there's probably buyers below it. Always in short, but I am not willing to sell down here. I think realistically the bulls will probably make money. Getting late in the day that it's fairly difficult to do much of anything here. Another bear bar 74, but failed to close below 73, so a sign of weakness. 4 of the past bars have been bear bars. That's good for the bears. Increases the odds we go a little bit lower. But realistically, bears that are short, they'll probably exit above a bull bar. Getting a bounce on 75, that's a warning that we're probably going to pull back. Always in bears. If I wasn't always in bear, I would exit. I did sell 72, and then 73 when it started to go down and then up. Basically, let me say differently. I sold 72, and then about 2 minutes into 73, it was right around my entry price, and I closed the trade and I started buying. And the reason for that is if we're not going to race to the downside, it means we're in a trading range, and we're probably going to do the opposite. It's really important to understand the market cycle. The market's either in a trend or a trading range. And to understand when the market is in a trading range, buying the bottom third, selling the upper third. When it's trending, depending on the strength of the trend, only look to sell. So when you see a big bull bar like 37 closing on its high, that's the top of a tight trading range after a strong sell-off that's going to get a second leg. Don't sell the close, don't buy the close of 37. when you see a big bull bar, 68, no matter how strong of a bar 68 is, this is always the concern. 3 pushes up. 1, 2, 3. Sellers around the midpoint, but probably not going all that much, probably not going much lower. Some bears sell to close of 72. Of course, any of these bars, they scale in higher and they look to get out break even at their first entry. Good reversal for the bears, but a relatively big bar to sell below. Big bar means big risk, and that increases the odds that there's probably buyers below 75. You can see not a lot of traders interested in buying below 75. It's so late in the day that traders are really better off not doing anything here. The odds are we're probably going to be sideways in this range. Not a lot of traders eager to buy, to sell below the 75 low. Increases the risk that we test up to the upper third of 75. Bears getting a second leg down after 72, 73, 74. But new low of the day, probably buyers in this general area. What about buying at the market? Well, it's 250, and it's possible we get some kind of sell climax going into the day, into the end of the day. So really not ideal. We may end up testing yesterday's close. And it's possible we try and fall below yesterday. Bears that are short, they'll probably trail a stop above any bar at this point. Right at the low of the day, bar 1, testing near yesterday's close. Starting to find buying pressure increases the odds that we start to go sideways here. The danger of selling low. You see the point about putting a stop below 59? Let's see what happens here. We could quickly reverse up all the way back to the 71 low. But it's really too late to do much of anything. So why did this happen? Look at every low of the day and ask yourself, are bulls making money at new lows, or are bears aggressively selling at new lows? Obviously, bulls are making money at new lows. And that's why the market is reversing up here. $78 testing the 77 low, trying to form a micro double bottom. But we sold off 74, pulled back. Sold off again, 77, pulled back. Looks like we're going to be sideways here. It is interesting. We're so close to yesterday's low, which is the low of the week. That's possible we get a sell vacuum down to it in the final minutes of the day. Interesting day overall. Weekly chart. We're getting a reversal down. After a series of bull bars, we had 6 bull bars in a row, and that's good for the bulls. And that increases the chances that we're going to go a little bit lower. Is a good sell signal below 65 for a low setup? Is it a good sell signal below 65? Well, 65, there's a few issues with it. One, if you look at 65, where are you selling? You're selling in the middle of a tight trading range. And that's not necessarily a bad place to sell, but you have to think about it from this perspective. A trading range is neutral. And when you have a trading range, the market can break above the range and form a trend, or it can break above the range here, fail, and lead to a reversal back into the range. And then once you get a reversal back into the range, it can also attempt to break out beyond the range, and it basically forms an expanding triangle. So if you're selling below 65, you see what happened with 66. You sell below 65 here, and then you see 66, and you say, wait a minute, that's not the follow through I wanted to see. I better put a limit order to exit break even. And then you see what happened with 67. It went below it and reversed up. Other traders, they got stopped out above 64 here, and they sold again below 72. And then other traders, they looked at this and said, yeah, we might get a breakout, but let's see if it has follow through. And then you can see no follow through, bad follow through 69, bad follow through 70, bad follow through 71. Those bears who sold below 65 scaled in higher, and they made money. While I'm talking about that, one of the easy things that traders end up doing when the range gets bigger, traders get used to scaling in. And a lot of traders make the mistake of scaling in with really just too close of a stop. And they end up scaling in with a stop that is just really way too tight. And let me say it differently. They end up scaling in here and then scaling in a few points higher. When you're scaling in, you really want to scale in 4 or 5 points above bars, and maybe even more than that when the range is really big. It's easy when you're scaling in to end up entering, selling, and then selling 3 points higher when your stop is maybe 15 points away. And if you do that, that is just a really bad mistake. All right, so let me go back to the weekly chart. On the weekly chart, I think overall on the higher time frames, we're going to pull back. And consecutive bear bars, good for the bears. But we sold off, pulled back here, sold off again. We have a tail. That increases the chances that we're probably going to be more sideways than straight down. And therefore, really not ideal. But overall, I suspect we'll get to the moving average. We'll probably get a small second leg down. Even if we get above the highs, which I do think we will get to 6,000, even if we do, we're probably going to enter a trading range. So at some point, I think we will test back down here. But it could take a long, long time. And then daily chart. Daily chart, some interesting things happened. We broke below the moving average, good for the bears, increased the odds of a second leg down. We closed the breakout point above October 26th, good for the bears. This is a strong enough bear breakout that my thought is we would get a second leg down. Obviously, the rally today was disappointing for the bears. But you can see what happened. Traders sold near the high of yesterday. So you had bears selling, scaling in higher, and that increased the odds that we were going to get a second leg down. So strong enough breakout, we'll probably get a second leg down. But it increases the chances that we may go sideways because of the rally today. I mentioned that the bears really needed a strong follow-through bar. And today is not really what the bears want. It's not ideal. On the open, bar one, we have a bull bar closing near its high. Good for the bulls, increases the odds that we're going to go at least a little bit higher. And then bar two is a consecutive bull bar. Bull breakout, follow through, tail below one, but it closed, tail below 1 and 2, but it closed on its high. Good for the bulls. If 3 is a bear bar closing on its low, a lot of the buy the closed bulls may exit. But a bull breakout above yesterday's bar 76 or 77, that increases the chances that we may try and get a measured move up. Doji 3, probably buyers below. 4, outside up, good for the bulls, probably going at least a little bit higher. And then 5, we have a bull bar, but it's a doji. For the bulls, it's a 5 as a warning that we may pull back fairly soon. And then 6, we have an inside bar. You can call it a high 1, probably sellers above. 7, outside down, testing the low of bar 4. Good for the bears, good for the bulls, increases the chances that there's buyers near the bottom third of 4. For the bears, is it reasonable to sell the outside down bar? I would not. You're selling at the bottom of a tight trading range, the 4 low to the 7 high. And we're in the bottom third of the range, and that increases the chances we're going to go sideways. 8, strong bull breakout, good for the bulls, always in long, can buy for any reason, but you're buying after the market's pulled back, the 7 high to the 5 high to the 7 low. And therefore, there might be more traders buying a pullback than the close of bar 8. Follow through 9, still buy the close, but tail above 8, tail above 9. If you're buying closes, it's reasonable to exit below a bear bar, especially if it closes on its low. 10, another bull bar, good for the bulls, still buy the close, probably going higher. 11, another bull bar, but a smaller bull bar in a buy the close rally, increases the chances that traders may look to take profits above the bar. 12, bull bar, but closing on its high, probably exhaustion, and we'll probably test back to the high of 11. The bull bars from 8, 9, 10 are getting smaller. We have a small bull bar here, and then we have a buy climax 12. That increases the chances that we test near the bottom of the 12 low. 13, bear bar closing on its low after consecutive buy climaxes and near yesterday's high, right at the 5,800 round number. Always in bulls, you can exit below and look to re-enter above a bull bar. 13, 14 consecutive bear bars, probably going at least a little bit lower. Bad high 1 above 13. And then 15, strong bear breakout. Good for the bears, probably going at least a little bit lower. But if you're selling 15, you're selling a sell climax. Late, you're selling a sell climax in the bottom of a trading range at the moving average. Why is it the bottom of a trading range? Because we have a strong rally and a deep pullback, and that pullback is probably leading to a trading range and not an opposite trend. So there's probably buyers in this general area. 16, we sold off below 15 and reversed up. Good for the bulls, but a bad buy signal bar, probably sellers above, but the bears may not come in until the upper third of this leg. 17, inside bar, disappointed bears who sold during 16 may use 17 to buy back some of their shorts. And that's why 18 reversed up. 18, good bar for the bulls, increases the odds we go a little bit higher, but getting near the middle of the most recent sell-off, the 13 high. And therefore, there's probably sellers up here scaling in higher. But a big bar, 18, some bears will wait for a pause. 19, smaller follow-through bar, but probably sellers above. 20, reversal down, but forcing bears to sell after consecutive bull bars. 18, 19, increases the odds of buyers below. 21, second leg up, good for the bulls. Bull bar closing on its high, but a possible second leg up. We rallied 18, 19, pulled back 20. We're getting a second leg up on 21, and we're testing the 13 low. This is an area where bears will start selling. 22, bear bar, but failing to close on its low, probably buyers below in a second leg. Deep pullback, 23, good for the bears, adding to the selling pressure, increasing the overlap on the rally, and that increases the chances that the rally up to the 22 high is part of a channel, and channels typically evolve into trading ranges. 24, bull bar closing on its high, but a wedge. 19, 22, 24, so probably sellers above. 25, reversal down. Good for the bears, probably going at least a little bit lower. It's a wedge. 19, 22, 24, probably going to test the bottom of the most recent higher low, which is the 23 low. 27, 3 consecutive bear bars. Tail 26, tail 27, but still probably sellers above in a second leg down. 28, strong bear bar, closing on its low, increasing the odds that we're going to go at least a little bit lower. 29, bear breakout, closing on its low, probably going to go at Bear breakout, 28, 29. We tried to break out to the downside and we pulled back, testing the bottom third of the 16 of the sell-off to the 16 low, probably buyers below, scaling in lower. 30 inside bar, but a low one at the bottom of the trading range, the 16 low, probably buyers below in a pullback. But typically when you get a low one and the market pulls back, usually it gets trend resumption. Bull bar, 31, good for the bulls, but I suspect sellers above. We rallied 29, pulled back 30, rallied again 31, probably sellers in this area. 32, an inside bar, but not a great stop entry buy above. It's forcing bulls to buy what could be the top of a tight trading range, and that's why we reversed down 33. 33, you can call it 2 legs up or 3 legs up. Rally, pull back, second leg, or you could say rallied from the 29 low, pull back 30, rally to the 31 high, pull back 32, and then rally to 33. Increases the odds. If it's a wedge, increases the odds we get a second leg down. And then 34, we broke below the 34, triggered the sell below 33, but it's a bad stop entry above, so probably sellers above. 35, second leg down after 34, but a tail below the bar. Strong enough sell off to the 31 low that will probably fall below it. And that's what happened with 36. 36, good for the bears, but a possible wedge. We sold off 32, 34, rallied 34, sold off 35, rallied 35. And now we're selling off 36, so it's possible we reverse up on 37. 37, strong bull bar, good for the bulls, but probably sellers above. The bulls, they really need follow through with 37. If you look at 37, look where it's forcing you to sell. Here's the high of the range. There's the low of the range. It's forcing you to sell. It's forcing you to buy the 37 close right at the midpoint of the range. And selling or buying in the middle of a trading range is really not ideal. 38, bear bar, probably buyers below in a second leg, but a possible double top of 33 increases the risk that bulls will get trapped buying 37. And 39, strong enough bear surprise will probably get at least a small second leg, but a bad signal bar 38, big bar 39, we may go sideways. 40, bull bar, not ideal for the bulls to buy, but a bad follow through bar. 42, inside bar, probably buyers below scaling in, but will probably fall below the 39 low. 42, doji, second leg down after 39, but not a strong stop entry buy for the bulls. 43, an inside bar, probably buyers below, but why aren't the bulls getting decent stop entries? 44, downside breakout, trying to break out below the bottom of this small channel with a spike pullback channel here, increase the risk that we reverse up, and that's what happened with 45. 46, consecutive bull bars. 45, 46, probably strong enough for a second leg. 48, another bull bar, but a tail above the bar at the 38 low where bulls got trapped, increases the risk we start to go sideways. 48, an inside bar, possible micro double top was 47, and therefore 48 is a high one, but probably sellers above. And that's why 49 reverse down. 49, strong bear bar, good for the bears, probably going at least a little bit lower. 50, follow through, but a tail 150 at a new low of the day in a bear channel where bears are making money all the way down. 51, another bear bar, but body even smaller. Increases the risk that we may pull back before the bears get a second leg. Doji, 52, so bears selling closes, disappointed, and they'll probably look to sell higher. 53, strong bull bar. What about buying it? I would not. We rallied 52, pulled back 52. Now we're rallying again 53, and 53 is a tail above the bar. If we reverse down 54, that would create a low one. It would also be 2 legs on a smaller time frame, rally, pull back, second leg with the reversal down, and that's what happened with 54. 54, strong bear bar, but forcing bears to sell low in a tight trading range, so probably buyers below. 55, a bull bar, but forcing bulls to buy in a tight trading range to the upside, and therefore not a great buy above. Always in bears, I think it's okay to get out above 55. And instead, 56 reverse down And now we're getting a failed breakout below this bear channel. Bear channel, we had a spike down to 51, pullback 52, pullback 53, second leg 55, pullback third leg 56. 3 pushes down, 1, 2, 3, and now we're trying to get a reversal up 57, 58. 57, 58, more overlap increases the odds that there's buyers below, and then at some point we'll test up to the top of this spike and channel, which would be the 53 high. 59 outside up, good for the bulls. Probably going to get at least a small second leg up, but a big bar, big risk. 60 bear bar, probably buyers below it. 61 breakout, pullback buy, but right at the moving average, not ideal. And then 62, we have consecutive bull bars. High one buy 61, followed through 62, may go a little bit higher, but you can see not a lot of traders eager to sell, eager to buy in the upper portion of this tight trading range right at the moving average. 63, outside bar, probably going to go sideways. And then 64, we broke above the 63 high and tried to reverse down. 65, second entry sell, but forcing bears to sell an inside bar with 64 and a relatively tight trading range with the past 5 bars near after consecutive sell climaxes. Really not ideal. 66, failed breakout of the 65 reversal bar, possible high one buy, and call it a breakout pullback buy for the bulls, but a tail above 66 increased the odds that the bears will get a second leg down. Some bears who sold 65 will be disappointed in 66, and they'll look to get out break even at the 65 low. And that's what happened with 67. 65, the low of the bar is 66 and a half. Your entry bar would be 66 and a quarter. And then 66, you can see it went to 65, 75. So it went 2 ticks below your entry price. 68, bulls, you have bears giving up, bulls buying, but a tail on 68, and there's no follow through. 69, bad follow through for the bulls. 68 is a strong enough bar, will probably get at least a small second leg, and you can see what happened. 69, bad follow through, sold off, and then retested the high, and you had disappointed bulls selling out of longs, and that's what led to 70 reversing down. 70, you can call it a micro double bottom, but a bad high one, probably sellers above, and that's why 72 went outside down. For the bulls, 72, it's a possible wedge top. 60, 65, 72. A lot of bears will exit below the bar. A lot of bulls will exit below, and bears will sell. That was 71. 72, surprise, probably going to get at least a second leg down, but forcing you to sell in the bottom of the range, not really ideal. 73, a doji. Not a great buy not a great buy with the momentum down, but probably buyers below, and they'll probably look to take profits around the midpoint of the bar, and there's probably sellers above the midpoint of the bar. 73, 74, disappointment, probably buyers below. 75 reversed up, but a micro channel from 71 increased the odds of sellers above. 75, probably buyers below, but the buyers may not come in until somewhere below 60, 59. 76 followed through. 77, we tried to break to the downside, and then we reversed up, and you can see we went sideways into the close. For stop entries, you can buy above 1, you can buy above 2, and then you can really buy anywhere up here. Bulls get out below 13. Aggressive bears will sell, betting on a parabolic wedge. Bears, if they sell, they probably get out a couple of 3 or 4 points above any bar, certainly above 18. Bulls they can buy, but they get out below either 22 or better 25 because of the wedge. 1, 2, 3. Bears that are short below 25, they probably, do they get out up here? I think it's tough to hold short. And even though 37 is a big bull bar, it's forcing you to sell, forcing you to buy in the middle of a tight trading range. I think some bears will exit above 37, but it never triggered. Bears definitely get out above 45. Bulls will buy, but the rally up is fairly weak, and therefore a lot of bears will exit. A lot of bulls will exit during 49 as it's going down, and bears will sell. Always in short below 49. Bears can sell. And where do they get out? I'd get out above 57, or if you're smart, below any of these bars. Certainly above 59. Bulls can buy 59, but top of a tight trading range, not ideal. Better to buy a pullback. And then as far as the bulls, I think it's tough to sell below. I think it's tough to stay long below 65. So okay to get out of longs below. And then as far as buying up here, 3 legs, 1, 2, 3, really not ideal. And then 71, bears can sell. Bulls definitely get out. And then the bears, if they're short, they get out anywhere in here. For limit orders, you can buy below 6. You can sell above 13, but a little bit tricky to be selling when the rally is strong. Buyers below 15, and I thought sellers above 22, but you need a wide stop. Probably buyers below 20. Sellers above 19 or 20, or buyers below 22, and then I thought sellers above 22 for the third leg. I thought sellers above 31 during 33. I thought buyers below 35. I thought buyers somewhere down here, but you need a wide stop. And then there's sellers above 48, but are never triggered. Buyers below 52 during 54, 55. Buyers below 57, below 58. I thought buyers below 60. I thought buyers below 62. And then 69, it's tough to sell above 64 during 68. And I thought sellers above 70 during 71, sellers around the midpoint of 72, and then buyers below 75, scaling in lower. Buy the close, sell the close. I thought buy the close on 2, 3, 4, 5, 6, any of these bars for a second leg up. And then I thought sellers on the close of 14, sellers at the close of 15, but big bar climactics are probably going to pull back. I thought buyers on the close of 18 or 19, but tough to do. Sellers 27, 28, but it may end up going sideways. And I thought sell the close 49, but low in the range, tough to do. Probably sell the close 72, but really tough to sell in the bottom third of the range. Let me take a look at questions. Would you please look at the QQQ? Is this a double top and a wedge? Yeah, so they're asking, is it a double top here and a wedge top? Yeah, it is. But it's a tight trading range right here. The bears, they want a double top here and here with the second leg forming a wedge. They want to break below the neckline ultimately here, but I don't think they'll probably get it. Bears, they'd like this. We have a wedge. If we break below the neckline, it'll basically be a failed double bottom. You can call it a double top as well. And then we get a test down to the September lows. But you can call this a double top with the second leg being a wedge. Okay, question. Is buying the 47 close a credible buy right here? I'm long at this point when 49 happens. How do I manage the trade? Well, first off, if you're long and you see about like 49 racing down, you immediately just close the position. It doesn't matter where you got in. Problem with 49 is 49's climactic. Rallied with 45 has a tail, 46 has a tail, 49 has a bigger tail, and the bar is bigger than the body of 40. The bar 49 is bigger than 46, and that's climactic behavior at resistance, the low of 38. So really not ideal. And then I think when you see 49, you don't try and fix the trade. You just try and minimize the loss and close the trade as quick as possible. Is it a good sell? Is it a good sell below 65? I think I already talked about that one. But selling below 65, you can sell, put a stop above, or you can sell more higher by waiting for a bear bar 71 to sell. 65, I think a lot of traders, they sell 65, they're going to put a stop above 64. They get stopped out 68 and they look to sell again below 71. But it's 3 pushes up, 1, 2, 3. So traders don't have to exit. I think traders can take a chance. But this could have led to a double top and a measured move up. So I think it's okay to put a stop above 64 if selling below 65. Can you sell below 51 and put a stop at the 50 high? Yeah, that's a little bit low in the range. If you're selling below 51, you're selling a new low in a channel. In channels, traders are selling pullbacks, and they're using new lows to take profit. So selling 51 is really not ideal. But if you do, I think you probably need a wide stop. And do you get out on 53? I don't think it really makes a lot of sense. It's the first reversal after a strong sell-off. It'll probably get a second leg down. Okay, question. When do you use measured moves based on number of ticks versus measured moves based on the height of trading range and breakout bars? I see presenters use them interchangeably in different conditions. I'm trying to grasp why. I mainly just use measured moves based on the bars themselves, not so much based on the ticks or the points. You know, I get the logic of points. If you look right here, a lot of traders will take profit. They'll swing, they'll take scalps when the range is big at 10 and 20 points. So if you look for the market to go basically the equivalent of 10 points, so 40 ticks, if I'm doing my math right. But anyways, the point is, whether it's point or ticks, for me, I generally like looking for measured moves based on support and resistance. But there will be plenty of traders who will sell below a bar and go for 20 points, especially for a swing trade when the range is big, and therefore those become magnets. Okay, question. Brad, why did you say limit order buyers below 15? I thought limit order bulls would buy below 15 because 15 is a relatively climactic bar at support, the moving average, and therefore it's probably going to get bad follow through, so bulls will buy below it. Is the 30 minutes of the day at the end of the day, is the final 30 minutes of the day more unpredictable and avoid executing orders? The end of the day can be a little more, have more volatility and therefore a little bit more unpredictability. Really, it just means that there's more, it's closer to 50-50. But overall, most of the time, the market goes sideways. Why is 59 from yesterday a bad signal bar at the top of the range? Why is 59 a bad buy signal bar yesterday right here? It's in a tight trading range, and the channel down is fairly tight. So buying 59 is low probability. Whenever you have a signal bar in the middle of a tight trading range, it's really not ideal. And that's why there were sellers above 59. But you can see what happened. 59 is actually a micro. The reason it went down on 61, 59 actually closed, and then 61 went down and then up. And therefore, if it goes down again, it's 2 legs up and on a smaller time frame. But really not a great buy above 59. You can see there were bulls who bought 59 and more lower and got out break even. Looks like that is it for questions. So where do we go next week? We have a doji after a relatively big bar, and the odds are we'll probably test yesterday's low and fall below it. You have disappointed bears who sold to close, probably scaling in higher. They may look to buy back their shorts around the lows. But the bulls, weren't unable to get a strong reversal bar, and therefore we may go a little bit lower. We have basically a double top. You can call it a bull flag. We rallied, pulled back, bull flag. We broke below the bottom of the bull flag, and 5,700 is right below. So we may get a measured move target from the high of October 17th to the low of October 23rd, testing down here, but we'll see. Okay, thanks everybody for tuning in, and I'll give it 1 or 2 more seconds, but if there's no more questions, I'm going to go ahead and end the review. Okay, question. If more than 20 bars above or below the EMA, can I hold the bull or bear direction? Well, generally, if the market is above or below the moving average for the EMA, that is a sign of trending behavior. But really, it all depends on context. But we'll see. You know, let me find an actual example. It depends also how it's trending. This is trending, but fairly weak, but it's a lot of bars above the moving average. It's not near as strong as something like this. Here, lots of bars above the moving average, so fairly bullish. Today, not nearly as bullish, or not nearly as trending. We keep getting closes above the moving average, and that's a sign of a weaker bear channel, but channels can last for a lot of bars. Someone asked who's going to win the election. You know, it's always actually really interesting. If you watch the Emini during the Globex when the election's announced, you'll probably see pretty good volatility. So that's always fun to watch. But we'll see who wins. How many factors do you consider to identify always in? Generally speaking, I first think about the market as being either in a trend or in a trading range. And the more trending the market is, the more I'm only going to trade in that direction. The more, in other words, the more major the market is. If it's clearly one-sided, such as this or this, I'm only looking to buy. But once the bears make money below bars and it starts to enter a trading range, I start looking to basically buy below bars, scaling lower, sell above bars, scaling higher. Tight trading range here, and then we have a breakout 39 second leg. At that point, a lot of always in traders, always in bears get out above 45, but we might be in a bear channel. A lot of times you break below a trading range and you start to drift one way. Sell off, lower high, lower low, lower high, lower low, lower high, lower high. Lower high, lower low. And what that creates is traders, instead of selling new lows, they sell pullbacks. But generally, the more clear the trending behavior is, the less I'm going to go against that direction. All right. Hope everyone has a great weekend, and I will talk to everybody soon.